Well, welcome everyone. I'm Michaela Doyle with the Kellogg School of Management. Thank you for joining us today for our series, This is Kellogg, Interest Rate Environment and Bank Stability with Gregor Matloss. The virtual This is Kellogg series showcases Kellogg thought leadership and initiatives important to the future of the school. You can catch up on prior webinars in this series at our virtual events page on the Kellogg alumni website. We will put a link to that site into the chat now. Today's presentation will last 1 hour, and we encourage you to submit questions for Professor Matloss anytime using the Q&A icon at the bottom of your screen, and we will incorporate audience questions into the discussion as time permits. I'm now pleased to introduce Gregor Matloss. Gregor is the Howard Barrel Heisman Chair in Finance here at Kellogg. He is a research associate at the National Bureau of Economic Research, serves as an editor of the Review of Financial Studies, and is a former editor of the Review of Corporate Financial Studies and former associate editor at the Journal of Finance and Management Science. His papers in these areas have been published in several journals, including the American Economic Review and the Journal of Political Economy. His research has been featured in major media, including Bloomberg, The Economist, Financial Times, The New York Times, and The Wall Street Journal, and has had a direct impact on how regulators supervise financial institutions. His recent paper on the fragility of the U.S. banking system is the most downloaded paper in finance posted in the last 25 years on SSRN. Welcome, Gregor. Thank you for speaking with us today.
Hi, Michaela. Thank you for the nice introduction. I'm going to talk to you today about the interest rate environment and bank stability. And in some ways, I really have two goals. One is I want to give you a big picture idea of the connection between interest rates and how stable our banking environment is. The second thing I want to do is I want to say, well, if this is a real problem, are there ways to solve it? Three, why haven't we done so? And I will build all this around the recent SVB crisis of 2023, which Michaela mentioned is some of my more prominent work. The second overarching goal I have is I will mostly talk about my work on this topic to give you a sense of what's happening at Kellogg, since you're all alumni, so you get a sense of sort of how our research is interacting with the world. Okay, so let's now step back and talk about interest rate environments and bank stability. To give you an idea, in the last 50 years in the US, we've had three large periods of bank failures. The early 1980s to sort of the early 1990s, we had the so-called S&L crisis. In that crisis, over 1,000 savings and loans, aka banking institutions, failed over about 10 years. Then, of course, we had the Great Recession. In the Great Recession, we had on the order of 500 banks fail. And recently, we had the SVB crisis, or SVB First Republic and a crisis, in which three banks really failed. But I'll show you first that these banks were enormous, and that part of the reason why more banks didn't fail was because we de facto bailed them out. Okay, so that's where we're kind of going. How to give you a sense of where we were in 2023 on interest rate stability. So take a look at this red line here. This shows you what happened from pretty much Q1 2022 over the next 14 months with interest rates in the US. Interest rates shot from 0 to about 5%. This was the fastest, tightest interest rate increase we have had in the past four decades in the US. Okay, so this pales in comparison, other tightenings like the 99 or 2004 or any of the ones you might remember, 2015, are tiny relative to that. Okay? And what happened after this tightening was we had a sequence of bank failures. So for example, we had three banks fail. We had the famous Silicon Valley Bank fail, and then for the First Republic Bank, and then Signature Bank. You can see them here on the right-hand side of the screen. And what I want to point out here is that the failures we've had in 2023 were so large that they were jointly bigger in dollar terms than pretty much all the failures combined we had at the peak of the Great Recession in 2008. Okay, so the recent crisis was enormous in dollar terms. even though very few banks failed. This is quite different than, for example, the S&L crisis. We just had failures of small banks. By the way, if anybody wants to know after the talk what the difference was between these crises, I'm happy to talk about it. Okay, there are some quite important differences also, not just similarities. Okay, the other thing that happened in the recent crisis that was quite important is there were almost instantaneous policy interventions. So the Federal Reserve rolled out the Bank Term Funding Program. That was an enormous, massively subsidized line of credit that any bank could get from the Fed. Then Janet Yellen, the Treasury Secretary, announced, as I'll show you later, that the government is willing to protect all depositors to bail out banks de facto, and then sort of walked back this debate and so on. So what was interesting about this crisis was, for those of you who still remember, after the great financial crisis, we put in this enormous regulatory framework called Dodd-Frank Act that was meant to prevent bank failures, but if bank failures were to occur, we should be able to deal with them without a bunch of discretionary policy interventions that use taxpayers' money. We've clearly failed at that one, and I think that's why it's kind of important to understand what happened and where we go from here. Okay, so let's understand this in the scope of the paper that I wrote 3 days after SVB failed. So if you want to think about it, SVB run occurred on March 10th. That was a Friday. By Monday, my co-authors and I had a paper that explained why we had the SVB run. This is what Michaela referred to as the most downloaded paper in finance in the last 25 years. But we also stress test, aka we looked at the whole banking sector of the US and said, was SVB an exception, or are there other banks that could be in trouble for issues like SVB? Okay. So was SVB an exception? And if it wasn't an exception, what happened to everybody else? Okay. So in short, as I'm going to walk you through, why did SVB fail? SVB failed because it had an interesting combination of hidden asset losses, where we did the accounting of how big these were, and a very high ratio of uninsured deposits to insured deposits. I'll get to what that means in a second. Okay. It was not an exception. There were other banks like First Republic, for example, that kind of looked similar on important dimensions that were also large. So as I'll show you later, the regulatory response to SVB was, this is an exception, aka don't worry about the rest of the banking system. And B, this was just bad management. What I'm going to show you is neither of these were actually true. SVB might have had bad management, but if only bad management were to blame, there were many banks in the US that looked like SVB on dimensions that are likely attributed to management. Okay. And then stepping back, we wanted to understand, well, let's now wake up in 2023 or 2024, or even 2025, if you will, and ask, well, what is the state of the US banking system? And when we did this for 2023, we found about $2 trillion in losses to the US banking system that were caused by interest rate increases. So that big spike I showed you in interest rates caused about 2 trillion losses in the banking sector. That is large even for the US banking sector. It's on the order of all capital in the US banking sector. And then we showed that 186 banks in the US were at risk of runs similar to that of SVB. Okay, so let's get to this. Let's figure out whether we can make more progress on understanding A, why are banks at risk if interest rates rise? Is this necessary for banks to be at risk, or do there need to be special circumstances for that? And then let's talk about what else we might learn. Okay, so why might banks be at risk when interest rates rise? If you think about what banks do, is they borrow money, mostly from US households and firms. These are called deposits. You're familiar with them because you probably have them. Okay? They also take some other debt funding occasionally. They issue some bonds, some commercial paper, but that's really minimal. Okay. And then they, of course, fund themselves with equity. But for banks, unlike other firms, equity represents about 10% of all their assets. Equity is so small that in banks, normally we do not talk about leverage, we talk about capital. because leverage would be 90%, where the usual firm in the US has leverage on the order of 30%. Okay, so why would interest rate risk be a problem for banks? Because what banks do is they borrow money from depositors, but then they invest this money. And they invest this money really in two ways. They either issue loans to households or businesses. So they make a loan, a mortgage, for example, to a household, or a credit line to a business, or they buy securities. As I'm going to show you later, banks in the US actually buy a lot of debt securities. So loans that other people issued, they buy these claims. Okay. And the problem with loans or securities is that as interest rates rise, their value drops. So this is, if you've been following the recent debate in the market, you can kind of hear yields on bonds have gone up. That means the rates have gone up. And what that means is bond prices have been falling. So let me show you a little bit more concretely what happened in assets in the US that look like the ones held on bank balance sheets when interest rate rose. Okay, so here we have three in the left picture here. I'm plotting the market value of ETFs. So if you invested yourself, you could buy these things. That's why they're nice, because you can see their market value. And they're invested in three different things that are very relevant to what banks invest in. They are invested in mortgage bond-backed ETFs. In other words, these are mortgage loans. This is exactly what banks do. Banks' real estate portfolios are on the order of half of all bank portfolios. Okay, this is for households. This is commercial mortgage-backed securities. These are loans, commercial loans that you can buy yourself through your ETF. This is exactly, again, what banks do. It's a big part of their portfolios. Okay, and here we just have US Treasury bond indices. Okay, and as you can see, the value of all of those when interest rates were increasing in the US dropped by over 10%. So in 1 year, interest rates go up from 0 to 5. At the same time, because interest rates increase, the market value of things that you could buy, but are very similar to what banks hold, decreased on the order of 10%. This gets much more pronounced if the things you hold have a long maturity. So in other words, if you buy something that pays off over 1 year, that gets affected by interest rates very little. If you buy something that pays off over 30 years, like a 30-year US government bond, that declines in value much more. So US government bonds are safe, as in they likely don't default, but their values depend a lot on interest rates. So for example, down here you have what happened to the market prices of US Treasury bonds as rates rose for bonds that were more than 20-year duration maturity. Okay, and you can see that their value declined by over 30%. So if banks make 30-year loans that look like loans to the US government, then the loans of this kind of value declined by over 30% as interest rates rose. So what we were trying to understand is, okay, so if that's the case, if banks hold a ton of longer dated assets that are like loans for which we see market values decline, can we just do this bank by bank? Can we say, well, this loan that you have, or this category of loans, they look mostly like US very short-term treasuries. These loans you have, they look more like 10-year treasuries. They look like 20-year treasuries. They look like mortgage-backed securities. And from that, back out, even though banks don't report losses on these assets because of some funny accounting, what did it cost banks? How much value did things that bank hold lose at that time? Okay, how did we do it? We used publicly available data on about the 4,800 banks at that time that were FDIC insured. In other words, they had deposit insurance. Okay, and we literally took security by security class and loan by loan class and said, well, if you kind of sort of look like a mortgage loan, how much did the market value of these loans decline by? Well, then your value declined by this much. Okay, we did this for about 80% of banks' assets. 20% were a little bit harder to do. And we did it for all banks, and we did it in 3 days. And I'm going to soon show you the estimates. Now, Obviously, this looks like a very back of the envelope exercise. What's interesting is that it took the Fed and other institutions several more months to get this exercise done, and I don't think they got better numbers than we did. Okay, so we were pretty darn close to what really happened. The second thing that's worthwhile mentioning here is, if you care about the details, is one of the issues you kind of have to decide is, how do you treat loans? If you, for example, have a credit line with your bank, you'll be familiar with this, or if you have a credit card. Generally, your loan rate might be fixed for 1 year or 2 years, but then after that, it changes depending on the market conditions. So if it's a floating rate loan, how do you think about its maturity? And the way we thought about it is, well, if you're a short term, if the loan is fixed for a short amount of period time, then you're a short-term maturity loan, and that's how we're going to reprice you. Okay, so we did do this for all banks. We added it all up and see, well, how much did US banks lose in this 1 year in the value of their assets? And the answer was, well, on the order of $2.2 trillion, or on the order of 10% of all bank assets. This is on the order of how much capital US banks had. So to say this in more layman's terms, if this was a standard business in the US, this would be a business that would look like, at least in book values, would be insolvent. Okay, that's how the US banking system looked in Q1 2023. Okay, where did these losses occur? These losses really had mostly to do still with mortgages. Okay, these are losses on residential mortgage-backed securities, and these are the losses on residential mortgages, and they are the vast majority of the $2.2 trillion losses that occurred in this space. Okay, now notice that we did this calculation also for 6 months later, and if anything, the unreported losses kept on climbing in this sector. Okay, so at first blush, this does not look great for the banking sector, and it's not, but it's not as bad as it looks either. Okay, but before we get there, let's talk a little bit about how did this differ across banks. Okay, so let's do this. So it is true that all the banks lost on the order of $2.2 trillion, but if you look at the graph on the right-hand side, there were large differences between banks. So what you see in the graph on the x-axis is percent of assets that the banks lost because of the interest rate increase. So, you have here 10%. This is where the vast majority of US banks lies. Okay, when interest rates went up, their assets, at least as we computed it, fell by less than 10%. The other thing you should notice is where SVB fell. SVB is the big poster child of this failure. It was the first bank that failed. It's the first bank that had a run. SVB asset losses were bad. They were 16%. So on the one hand, that's pretty bad. 16% is somewhat large. On the other hand, about 500 other banks in the US had losses. All these banks up here add up to 500. 500 banks here had losses bigger in percentage terms than SVB. So you'll say, if these losses are due to bad management, and some of them might be, okay, then boy, there were 500 banks in the US that had even worse management. And second, boy, if SVB failed because its asset value just declined, we should expect many, many, many more other banks to fail. Okay, so, but stepping back, that tells us SVB was not special on the asset losses side, okay, which is both good news and bad news. Good news is we shouldn't expect that many banks to fail, or bad news, oh my God, many banks are going to fail. Okay, it depends on how you interpret it. So let's see if SVB was special anywhere else. Okay, so where was SVB special? It was special in how it funded itself. So, as I said, the way banks fund themselves is with either deposits or other things, but deposits really represent 75% of all funding of banks in the US, including equity. Okay? you can have two types of deposits. One is insured deposits. Those are the ones that you might have if you deposit under $250,000 in a US bank. But if you have over that, that part becomes uninsured. So if a bank fails in principle, though frequently not in practice, you could lose that money. Okay? So let's me repeat this again. Uninsured deposits are those that if your bank fails, you will not get the money back. Now, as we'll see later, SVB uninsured depositors were bailed out. Okay? So that might decrease their reluctance, but in principle, they could have lost money. Okay, now, where does SVB look interesting? So if you look, most US banks are somewhere here. They have about, as a share of their assets, about 20% of their funding is uninsured deposits. Remember, I said something like, well, about 3/4 of the funding is deposits, so 20% over 3/4, we're talking about 1/3 of all funding is deposit funding. Of all deposit funding is uninsured deposits. Okay. For the average US bank, when we've weighed by assets, bigger banks have more uninsured deposits. You're about half of deposits in the US banking sector are insured and half are uninsured. What you can see is in the data, and this is what got us really thinking, in the data, this is where SVB really stood out. Okay. SVB had what I would call 80% of uninsured leverage, uninsured deposits to assets. Now, why are uninsured deposits important? Uninsured deposits are important because if you are insured and you think your bank will fail, you don't have to run. Because in the US, if you have insured deposits and the bank fails, you can literally, and this is, I'm not misusing the word literally pull out your deposits the next day. The FDIC is incredibly efficient at resolving banks. So when a bank fails, insured deposits are 100% instantaneously protected, and you can get them out when you want. Uninsured deposits may not be. So if you're an uninsured depositor and you see that other people are pulling their money out of the bank, you should ask yourself, well, if all of them do, will the bank fail? If the answer is no, if many uninsured depositors run, my bank is still stable because it's one of these banks that has very, very few uninsured depositors. I don't really worry because if my bank doesn't fail, I can still get to use my deposits and I can do all sorts of useful things with my deposits, like pay payroll that's due on Monday. I don't want to withdraw, right? So if there is very few uninsured deposits, you definitely do not want to withdraw your uninsured deposits yourself because chances are you want to use your bank. However, if you're like SVB or First Republic, then you have huge incentives to withdraw your deposits because A, you will lose your money potentially if the bank fails. And B, if the bank fails, chances are there might be some hiccups with using your payroll. Okay? So to give you this picture more broadly, how did the US banking sector look at that time? On the x-axis here, we have what is the share of these uninsured deposits to assets in the US. You can think about what's the chance that your deposits are going to freak out as a share of assets. Okay, these are the deposits subject to freak out. Yeah, what you can see is first SVB. This is what I showed you before. Is here. SVB certainly had a lot of uninsured deposits as a share of assets relative to all the other banks. But you can also notice it is by no means alone. There is a good cluster, and remember, these big circles are bigger banks of non-trivially sized banks that are somewhere here. The good news is the average big banks lie somewhere here, and then there's a lot of banks who just wouldn't be prone to freakouts. Okay? The second thing you want to notice is the y-axis. The y-axis is, well, how big are the bank losses? If banks' losses were very tiny, then even if SVB, and we did a calculation, even if SVB depositors ran, it wouldn't be a problem because the bank would still have enough money to pay back everybody else. So if there's losses are small, you don't need to worry. If losses are enormous on the order of 30%, then as an uninsured depositor, you have to start to worry. If everybody runs, am I going to get my money back? Okay. So for example, let's look at this bank up here. This is one that lost almost 30% of their asset value when interest rates went up. But notice, only a very small part of their assets is funded by uninsured deposits. So even if all of these people freak out, chances are they can repay them and still have money left to pay everybody else who will not freak out and will stay there for the long run. Okay. So in short, where is the danger zone? The danger zone is up here, right? You have big losses, you have big uninsured depositors, and you want to understand how big of a circle should you draw for a bank to be in danger. Obviously, SVB here is in danger. Should the circle be an ellipsis? Are all these banks in danger, or should the circle be like this? What is really the combination of uninsured deposits and asset losses that will lead to problems? Okay. And this is, I think, partially where we came in. We didn't just diagnose the disease, but we said, now that we know what the problem is, can we take this and map it to something quantitative? Can we find out which banks are subject to potentially runs and which banks are in a good place? So their losses are not that big, even though they have a lot of runnable insured deposits and so on. We try to make a quantitative point of actually figuring out how many banks were subject to runs, okay? And this is what we did next. And if anybody cares, I can definitely tell you the details. But right now, what I want to focus you on is just the numbers, okay? So we quantified that exercise and we said, well, one thing that is really, really hard to determine is what share of your depositors is prone to panic. Because if nobody panics and everybody decides to keep their deposits in a bank, the bank will not fail. So we said, well, let's do a back of the envelope, one of those, and say, imagine about half of your uninsured deposits are prone to freak out, and the other half is just going to be kind of like hanging out and not doing anything. What are the chances that your bank fails, that if you're the kind of uninsured depositor who would run, you run when you see other people run? And this is the number that then got cited everywhere in the media, 186 banks. Okay, so what we found out is out of 4,800 banks in the US, about 186 were prone to an SVB style run if people freaked out. If people didn't freak out, everything is good anyway. Okay. And if you look, the losses that would be incurred at that point would be on the order of $500 billion. Okay. And now, of course, you have to decide for yourself, which world do you think we live in? Are most uninsured depositors very sleepy and not prone to runs? Then we still have about 60 banks in danger in the US. Or are many people prone to freak out? And many people, I really mean businesses, because these are big accounts. Okay. Then we are somewhere closer to here. Okay. So when you hear the story about social media driving the SVB run, it kind of story says we are closer to here because social media coordinates a lot of people to freak out. Okay. Now, so this is what we did. We said, we think about 180 banks could be at risk with sensible assumptions. Okay. Then the question is, of course, we did this exercise. We did 3 days after SVB failed. Were we right or were we wrong? And the nice thing about hindsight, it's sometimes, you put the thing out before things happen and you can check. Okay. So of course, I don't want to benchmark us to were we absolutely correct on which banks would have failed. That'd be very difficult. But I think I can benchmark us relative to policymakers. Okay. When you look at the Barr report, which is, he was the vice chair of the Fed in charge of bank supervision. When the report came out in April 2023, this is a month after SVB fails. This is about 3.5 weeks after we wrote our paper. The Barr report really blames SVB failures on two issues. One is liquidity. Liquidity appears 318 times in the report. And if you want to think about what liquidity is, liquidity really means the problem with SVB was they had hard to sell assets. And if they sold them, then they would have incurred big losses. And therefore, we should make sure that we help with liquidity. I'll tell you how that happens. Okay. And then the second Barr report was, and the problem with SVB was they had really bad management. And as I said before, bad management really means SVB was an outlier. Don't worry about anybody else. Okay. So what was the regulatory response based on this? Well, if you think that the problem of banking is that they have hard to sell assets, then all you need to do is when depositors run, you give the bank a loan so that they don't have to sell any of these hard to sell assets, and then the issue passes by. They can slowly replenish their deposits, they repay the loan, and everybody lives happily ever after. Okay? And indeed, there's a huge liquidity intervention by the Fed. The banks drew about $140 billion in 1 week in 2024 later on. But the interesting thing is, despite the fact that the Fed and FDIC rolled out huge help, banks kept on failing. As I showed you before this picture, we've had historically large failures. Okay, we had First Republic fail, which was a huge failure afterwards. In our data, we predicted First Republic failure, and First Republic did indeed fail, as well as Signature Bank. Okay, if it was a liquidity problem, they shouldn't have failed. There was as much liquidity in the world as you could have possibly wanted. Infinite amounts of lending from the Fed. If lending would have saved the problem, that did not happen. Okay, and about a year later, FDIC identified about 60 banks at risk in the US, despite the fact that there were huge interventions to help the banking sector, which of course our calculations did not take into account. Okay, so in short, I would say for doing something overnight, we did a pretty good job of diagnosing what are the issues right now in the US if you want to think about the interest rate environment. The issues are asset losses due to high interest rates. Issues are big uninsured deposit runs. Issues are not liquidity. Liquidity was an issue back in the day. If you look at the famous Diamond Didvik paper, which everybody relies on, Doug is amazing. Okay, so that paper is the fundamental paper of bank runs, and it says liquidity is the main issue. And it's true that in the S&L crisis in the 80s and 90s, that was indeed the case, and that's why Dodd-Frank resolved the liquidity issue. SVB had U.S. Treasuries. There is almost no other debt security in the world that is easier to sell than U.S. Treasury loans and bonds. Okay, so in short, right now, not 20 years ago, not 30 years ago, if you want to understand the problems of interest rate increases, you just have to understand two things. You have to understand how much the interest rate risk affects the assets, and then the uninsured funding. You still have to do the calculation, but for that, you can read the paper. Okay, so now we've had banking failures. Dodd-Frank failed because we've had to have billions and billions of dollars of interventions that shouldn't have happened according to Dodd-Frank. The question is, where do we go from here? Okay, if you realize that the US banking sector is not failure free from something as simple as interest rate risk, and interest rate risk is very simple, how should we solve it? Okay, and as you can see, solving it in the short run is very easy. You just throw money at the problem, like the bank term funding program by the Fed, or you just cover a lot of uninsured depositors. Of course, these issues then cause these interventions cause issues in the long run, because now banks, at least people funding banks like depositors, know they will be bailed out, allowing banks even cheaper funding of deposits. Okay, so two things were proposed as a solution. One was, well, we should change deposit insurance. Not clear how we should change it, but we should. And if anybody wants to talk about it, I'm happy to answer questions on this. I have some opinions on that one. Okay. And the second was, we should increase capital requirements, and not by much, by 2 percentage points. And that was a law that was an intervention that was making its way through to policy, but then it failed due to a big bank regulation, lobbying. And that's the one I want to talk about. Okay. So let's spend the last maybe 10 minutes talking about why I think bank capital requirements, which would solve most of the issues we have with bank runs, are not bad for the US economy. Now, they are bad for banks. They would make banks less profitable, but probably not terrible for the US economy. Okay, so if you look at the media, what you see instantaneously is that claims that capitalizing US banks more would really affect bank lending. So for example, as soon as increased capital requirement came out, JP Morgan warned that 86 million customers would have to start paying for their accounts. Then, for example, this is a fun one. So let me actually point you to it. The National Housing Conference said, if these standards are adopted, they will have a devastating impact on our efforts to increase Black ownership and disadvantage all first-time and in particular first-generation home buyers who do not have the benefit of multi-generational wealth or higher than average incomes. So that's kind of interesting. These are bank capital requirements, but as a fact, almost over 80% of mortgages given to US low-income households are done by non-banks. In other words, the bank market share in lending to these households is about 20%. Okay. So in other words, it is kind of difficult to see why, if banks have a very small part of this market, increasing capital requirements will be a problem. Okay. Then of course there are some other claims, which is Jamie Dimon's the proposed Basel III endgame rule will harm everyday Americans. Basel III was increasing capital requirements. And then, large complex banks are essential to thriving US economy and American competitiveness, which I completely agree with. I think banks are incredibly important. I think better capitalized banks would still do a lot of the essential functions. So let's see what I back my claims with, okay? So here is one piece of evidence. This is from a paper I did with some of my co-authors, Erica Jang, Amit Sirur, and Tomek Piskorsky. And to give you a sense, what we do is we look at lenders who are banks and who are non-banks, and just simply look at how much capital they have. These are banks. All banks have about the same capital, which is on the order of 10%, which is the capital requirement. These are bank-like institutions that do not take deposits, that do the same type of lending. In fact, they lend to the same households in the same locations at the same point in time. They're direct competitors. What you will notice is that pretty much there is much more capitalized competitors than banks that are making the same amount of loans. This huge difference you see between them says, what the proposal was of the capital requirement was to increase this by 2 percentage points. And the claim was, therefore, no lending will happen in the US. But we see lending happen in the US all the time with capital requirements from 15%, with capital, not requirements, chosen capital by bank-like institutions. The big difference is they do not get insured deposits, so they do not have access to a lot of cheap funding. Okay. The second reason why I do not think increasing bank capital requirements would be that big a deal is because banks are simply not that important anymore to lending in the US. Okay. And I'll tie this to a recent topic that you might have heard about. Okay. So this is over the last 60 or so years, the share of US aggregate lending to households and to businesses, non-financial institutions, that is done by lending on bank balance sheets. In other words, things that will be compressed if we increase capital requirements. And what you can see is that it used to be about half of lending in the US was held by banks. Now we're down to 1/3. And the reason for that is, well, you might know yourself. You are probably investing directly into lending through ETFs or mutual funds or other instruments that are loans made by people other than banks. Okay. So this is not an issue only of mortgages. This is a big issue of US business lending here in blue in the right-hand side picture. Here, business lending also has moved way away from US bank balance sheets. If you think about it, lending to business in the US is mostly done by non-banks, okay, especially where it's held. Banks might facilitate it, but then they don't hold the loans, they sell the loans, okay. But for households, it used to be that banks held most of the loans. This has significantly declined over the last 60 years, okay. To give you a more recent analogy, here is this trend in private credit. If you've heard about private credit, it's recently been all the rage. Apollo is now doing lending to firms in the US directly, okay. Just to understand, private credit is taking market share from banks, but it's market share that has tremendously declined over the last 50 years already. And most lending in the US by now is not even close to businesses, even, is not even close to being done by banks. So yes, it is true. Private credit is taking something away from banks in lending. But what they're taking away is something that already has a small share as is. But the important thing for us is if we think about bank capital requirements is, wait a second, if banks shrink because capital requirements indeed are restricting their activity as they claim, they still represent a very small amount of small part of all the lending. So we cannot expect lending to shrink tremendously given that. Okay. And just on the savings side, it used to be that U.S. households saved a lot with banks in the U.S. It used to be 21% of all financial wealth of U.S. households went to bank deposits. Now it's down to 13%. In short, banks are just much less important in the US economy, both for saving and for borrowing, than they were 50 years ago. And therefore, shrinking them would not have first order consequences on the world either. Okay. And just so you understand, banks have changed themselves as well. If you say banks do things that are, hard to replace, and we should really have more banks because what they do with their money is lending. Half of the money that US banks now have on their balance sheet is devoted towards buying securities. In other words, it's loans made by other people, sometimes by the US government. So that should puzzle you. That should say, wait a second, if the extra dollar that the US banks get goes to buying loans made by other people, like the US government, or somebody made a loan to a business or to a US household and then the bank bought, why is it a huge problem if they buy some fewer loans and US households buy more? Okay. But in short, this recent piece of research that I have makes me think that banks should easily have more capitalization than they used to, be safer than they were. Because if they have a lot of capital, bank asset losses just don't matter a lot and be much less risk prone. But I don't think we're going to see that anytime soon. Okay, so this is where I wrap up, and I'm happy to now answer any questions you might have. Thank you very much.